Assalamu alaikum and good evening to all of you on my side. And today is day 5. We are going to start the topics. Today we are going to cover some of the part of the consolidation that was left in the last session. And in addition to this, we have to cover the ratio analysis topic as well. So let's start the session. Can you hear my voice now? Hello. Can you hear my voice now? Okay. So just a quick recap for the what we had discussed in the last session. There is a question for you guys. I want all of you to do just attempt this question in 1 minute, then we can continue further. So, what is the right answer for this question? Okay, so let's start the session. Option A is which of the following should be accounted for the subsidy in a consolidated statement financial position of Preece Company? First option is Gilbert Company. Preece currently owns 40% of the share capital of the Gilbert Company and holds option to purchase another 20%, which it can exercise immediately. Second part is Groves Company. Preece Company owns 60% of the Groves Company and has appointed majority of directors to board of directors. Roach Company. Preece Company owns 80% of the Roach Company and Roach is loss making. Preece is considering selling it in the near future. So all three actually are subsidiaries. So the first one, second one, third one, and all are subsidiaries. So the right answer for this question is D actually. So how about first one? Currently we have got 40% shares, but if we acquire for the 20% share, then it will be my subsidiary company. Okay. So IFRS 3 says that whenever you are analyzing the control, you have to see the current number of shares that the company has acquired and the future exercisable shares. But the situation must be that portion of the shares that we can exercise and purchase in the future should be currently exercisable. So if it is exercisable right now, then you can acquire 20% new shares because of the option. So whenever you are calculating the percentage, you have to consider the current shares and the exercisable shares which you can exercise in the future. So actually, the parent company has acquired 60% shares in this situation. So that is why one is also a subsidiary. So these are the provisions of IFRS 3 and IFRS 10. Yes, it can be exercised in future, but still it will be the subsidiary company because we have got the option. Okay. The next point. Here is a question for you guys for the unrealized profit. What is the debit adjustments to be made to the group's retained earning to reflect the unrealized profit in the inventory at 30th June 2005? I am actually giving you the question which, according to the examiner, is the most challenging from the student side. So these are the most important exam questions in which mostly the students will not be able to answer it correctly. So that's why I'm giving it to you to do this sort of practice. We haven't purchased these shares, but we have got the option. If you have got the option which can be exercisable, that means that you have actually the shares, but you have not yet exercised your option. So that's why these type of shares should be included in calculating the control. Okay. How about this question? They acquired 60% on subsidy sold goods to the parent for 150,000, a markup of 25% on cost. During the year, 1/5 of these remaining unsold. So 150 divided by 125 multiplied by 25, 30 is the amount of the profit, and the unsold stock is 1/5, 1 divided by 5, so it will be 6,000. But because the subsidiary company has sold goods to the parent company, so we have to make adjustment of 60% of this value. So the right answer for this case will be B. Very good. So the right answer is B. Is that clear to all of you? This is what we had discussed in the last session when we are talking about the accounting entries. Okay, some people want the explanation. If you remember the point that we have discussed about the accounting entries in the last class, we have discussed that if the subsidiary companies have sold goods to the parent company, an accounting entry will be retained earnings debit, NCI debit, and stock credit. So in this situation, 6,000 is the amount of the unrealized profit. But in the retained earnings, you have to place 60% of the amount because 40% will be adjusted against the NCI. So that's why B is the right answer instead of A. Are you getting this point? Yes, we have to proportionate the URP whenever the subsidiary company sold goods to the parent company. Because the parent has acquired 60% shares of the subsidiary company, that means the 40% of the shares should be distributed to the NCI. So whenever we do adjustments in the profits of the subsidiary company, it should be proportionated between the group and NCI. If we sold, the answer will be 6,000. Yes. How to calculate the stock? So can you please explain why not 504.5? Okay. The question says that the parent company, subsidiary company, has sold goods to the parent company having a value of 1,50,000, and the gross profit markup is 25%. So we have calculated the profit element from this 1,50,000 by dividing this amount by 125 and multiplying it by 25. So it is actually 30,000, the amount of the profit the company has made out of this sale transaction of 150. But the question says that company has remained only 1/5 of this stock. So 1/5 of this stock means 1 divided by 5. So it will be 6,000 is the amount of the profit that is still remain in the warehouse. And we have sold 4/5 of this stock, 4 upon 5. So 24,000 is the amount of the profit that we have sold and realized, which is not no longer required to be adjusted. But 6,000 is the amount of the unrealized profit that you need to adjust. So the accounting entry shall be stock credit, retained earnings, and NCI debit. So that's why I'm giving you these questions, because these are very technical and easy, but technical questions that the examiner has given in the examination. The mostly the students will not be able to answer these questions. So that's why I'm giving you guys to do the practice of these type of technical questions. Okay, moving forward. Okay, here is the net assets of subsidiary company. Share capital, share capital, share premium, share premium. Do remember this point, the share capital, share premium account will remain the same from the acquisition till the reporting date. So at your level, it will not going to be changed. But the retained earnings at acquisition and reporting date will be changed. And same in the case for the reserves. Now you have to do the fair valuation adjustments, because according to IFRS 3, all the assets and liabilities of the subsidiary should be measured at the fair value at the date of acquisition. So there might be sometimes it might be an upward revaluation, or sometimes it might be a downward revaluation. So whenever we have got the upward revaluation, then you have to do an excess depreciation adjustment. And whenever we have a downward revaluation, there must be a reversal of depreciation. Impairment loss should be reported on the reporting side. Unrealized profit will be considered here only when the subsidiary sold to the parent. And when we have excess depreciation, we might have some excess amortization as well. So these are the basic things that we do. So for basic understanding, we are giving the name of the reported the net assets at acquisition with the name C, and the net assets at the reporting date with the name D. To understand this next slide. So how we calculate the overall retainer? Mostly the students are facing problems in the calculation of retained earnings in NCI. So that's why I'm giving you this format. If you follow this format, you will get the right answer in all the cases. So first we take the holding company's retained earnings, means the parent company's full retained earnings. Then the second thing is subsidiary companies post acquisition, means D minus C into group percentage. Then you are required to adjust the share of associate profit if they have any. Then impairment losses should be deducted from here. Unrealized profit if the subsidiary company sold to the parent. Sorry, if parent sold to the subsidiary. Similarly, there might be some cases when you face the unrealized profit on the fixed assets. There might be a situation in which the parent company is selling the non-current assets to the subsidiary company, or the subsidiary company is selling the non-current asset to the parent company. In this situation, you have to make the adjustments net of depreciation. Negative goodwill is my income. It should be added in the retained earnings. Unwinding of discount on the deferred consideration, as we have previously discussed, this concept should be recognized in the retained earnings. It's going too fast. What's wrong with you, my laptop? Okay, sorry. Then the changes in the contingent consideration, as we have discussed previously, should be recognized as an income or expense. Any gains or losses of a parent company related to the other investments under IFRS major under IFRS 9, and those investment, if they are major, the fair value through P&L, and its gain or losses will be reported here. An acquisition related cost must be charged an expense. So if you remember this slide, your retained earnings will be 100% correct. Second step is NCI acquisition, then post acquisition D minus C into NCI percentage, and you got the value of NCI at the reporting date. Now here I'm giving you the question to solve it for the calculation of NCI. So all of you are required to solve it and give your answer. What is DC? DC means D minus C is actually the adjustment of retained earnings, net assets at the end minus net assets at start. Net assets at the reporting minus net assets at start. We are just giving the name of D minus C. So here is a question for you guys to attempt. I'm giving you just 1 minute to solve it. Again, restricting the WhatsApp group for the time period when you're giving the class. So what do you think is the right answer for this question? Yes, the right answer for this is D option. Very good to see the students are giving a very right answer. I am very much happy to see when I see the right answers. Is that clear to all of you guys? Please solve. Okay, I'm going to solve it. NCA at the acquisition is given to us with a value of 1100. Unrealized profit will be adjusted in here because the subsidiary is selling goods to the parent company. Okay, and it's already mentioned that the unrealized profit is 550. So 30% of the profit will be allocated on NCI. Then we have to adjust the excess depreciation on the revalued asset, which is 1500 divided by 30. So it will be 50. So 50 into 30%, because 30% will be reported in NCI. So these two must be deducted values. So we take it on the brackets, the negative sign. This one too, negative sign in brackets. Now finally, the share of the profit which the subsidiary company has earned during the period is 3200. So 3200 into 30% will be the share of NCI. So by adding these two all figures, we got the value of NCI. The answer is 1880. Fair valuation adjustment. What about the fair value? Fair valuation adjustment was initially recognized in the goodwill. So the impact of the excess depreciation of the fair valuation adjustment will be reported in NCI. Is that clear? Will be like this. Actually, these are the questions which we are discussing right now are the most challenging questions in the examination according to the examiner's report. So these are the challenging questions from the examiner's report which I have collected in order for you guys to tell you that these are the toughest and difficult questions for the examination. But you cannot say that all questions will be like this. There might be some easy and basic level questions as well. But believe me, if you prepare yourself and follow all the instructions that I'm telling you, you will find the paper very easy to pass. So if this paper is very easy to handle and pass. And even you can score very good marks. So should we move forward? Depreciation, one of the students is asking for the depreciation. It's 1500 divided by 30. You got the value of the depreciation, which is 50. Now the concept of associate. As we had discussed previously, that the associate means an entity in which you have got the significant influence. Significant influence means the power to participate in the financial and operating policies. Associates should be accounted for under equity method. All associates should be accounted for under equity method. And the basic presumption is that you must have 20%. If you have 20% to 50% shares and you have got the significant influence, then it means that it is your associate company. So the most important point is significant influence rather than the percentage. Now, how we measure the associate company under equity method? So when we are going to measure the associate company under the equity method, first you have to see that you have to note it down that the associate should not be consolidated. So we never consolidate the assets and liabilities and revenues and expenses of the associate company for the purpose of consolidation. We only consolidate parent and subsidiary company. So there is a single liner adjustment of the associate company. You can see in the bottom of the slide that investment in associate will be measured at cost of the investment plus the share of the post-acquisition profit minus impairment loss minus dividend received if it is included in the investment, and minus unrealized profit only if the associate purchased from the parent or subsidiary. So these are the basic requirements for the associate company. So do you people remember that we skipped one of the note previously in our last session? If you remember that we were doing the question with the name Dargent. We have skipped one note. So let me show you the note so you can do it. And without attempting that note, we have balanced our income statement and balance sheet. So I think it might be from March paper. Now this was the question that we were attempting. We have attempted in the last class. And you can see here there is an investment in associate having a value of 4,500. Okay. And now you can see the note number 4, which we did not attempt in the last class. Just reading this note and based on this format, you are required to calculate the investment in associate. Okay. So just look at the format. Investment in associate is equals to cost plus the share of the post acquisition profit into associate percentage minus impairment loss without any percentage minus dividend received if it is included in investment minus unrealized profit if the associate purchased from the parent or subsidiary. So this is the format on the basis of which you are required to solve this note. So I'm switching towards the notes. So this is the note. Please read it carefully and reply with your answer. Investment in associate is having a value of 4,500 and we have acquired it in April 2005. and now it's March 2006. Yes, the right answer is 5,700. Very good. The right answer is 5,700. What if the parent or subsidiary purchase goods from the associate? Then there will be no adjustment in investment in associate. It will affect the retained earnings and inventory. So, do you people want me to solve it? Yes, please. So, you can see here that the value of the investment in associate that has been given to us will be 4,500. And in the post-acquisition period, the associate company has earned of a profit of 6 million. So 6,000 into 30% share will be allocated in associate company. So do we have any impairment loss? No. Do we have any unrealized profit? No. Do we have any dividend received which is included in the investment? So you can see here that the Dargent company has recorded share of dividend received from the Emery company in the investment income and cash. So they have already recorded the dividend in the books. So what we are required to do is to reverse the value of the dividend. They have recorded dividend of 2 million. So 2,000 in 2,000 into 30%. The this amount should be deducted because we have already recorded the whole of the profit, so no need to record the dividend again. So by adding these figures, we got the value of 5,700. Is it done? So till we are at 9:13 p.m. right now. It's 9:13. So let's move on towards the next slide. Now NCI. According to IFRS 3, we can measure the NCI either on the fair value basis or on the proportionate basis. So in a very rare cases, examiner might ask you to calculate the NCI on proportionate basis. But whenever you see questions in examination or the exam kit, you will always find the questions related to the fair value method. But I'm just giving you one example for the NCI measure at the fair value and NCI measure at the proportionate basis. So let's give an example. Suppose if the cost of the investment is 4 lakh, there will be no impact either in both the cases on the cost of investment. And the value of the NCI has not yet been decided by us. Now, fair value of net assets. So in the fair value approach, we take the fair value of NCI. So assuming the fair value of NCI is 2,50,000. So the total amount will be 6,50,000. Do remember this, that we are doing the fair value approach for the NCI. Assuming if the fair value of net assets having a total value of 3 lakh. Then the goodwill will be this amount plus this amount. So my goodwill is 3,50,000. So how we have measured the NCI? We have measured the NCI on the fair value basis, which might be given to you in the examination, or if you need to calculate it, you can calculate it by NCI shares in the subsidiary multiply by share price of subsidiary that we had discussed previously in the last class, how to calculate the NCI acquisition. But I'm telling you actually the fair value approach. Now we are following the proportionate approach for the NCI. So the cost of investment will be the same, the fair value of net asset will be same, but NCI will be calculated at the proportionate share of the fair value of net assets. How we can calculate this? Suppose in this situation, parent company has acquired 80% shares of subsidiary company. So 20% will be the value of the NCI. So we have to take the fair value of net assets that we have calculated into 20%. So this is called proportionate share of NCI. So these are the two formats through which we calculate the goodwill. Now the goodwill in this situation will be 4 lakh 60. So goodwill in this situation will be 4 lakh 60,000 plus 3 lakh 1 lakh 60,000. So that's the idea between the fair value approach and the proportionate approach. The only difference is the calculation of NCI. The fair value approach, we use fair value of NCI, and in the proportionate approach we use the proportionate share of NCI in the fair value of net assets at acquisition. So this is the difference between two approaches. Yes, this is also called partial goodwill. Now in the proportionate share, we take the percentage of net assets at acquisition. So NCI will be calculated as a percentage of net assets. So we have to calculate a percentage of 300,000 as a fair value of net assets. So NCI will be the 20% of this amount. So NCI will be the 20% of this 300,000. So this is how we calculate the NCI in the proportionate case. So sometimes examiner might ask you to calculate the goodwill using the proportionate case, in which you required to calculate the fair value of net assets and take the percentage of NCI that will become your NCI at acquisition. Yes, we can also solve this by ignoring the NCI even as well. Now there is another way to solve this question. No need to take NCI here, and take 80% of, this is also called proportionate share calculation, 80% of the net assets. So in both the situation you will get the same answer. So I think handling this situation is more simple to understand. So if you are taking 80% cost of investment, then you can take 80% of the fair value of net assets, and you've got the goodwill of. These both are the ways to solve proportionate share. So I think so this goodwill 1,60,000 is called partial goodwill. Moving on to its next slide. So here is a question for you in which you are required to calculate the total equity. I'm giving you just 1 minute to solve it and give your answers. So the right answer for this is B. B is the right answer. So I'm moving forward. Does anybody want some explanation? Okay. The question is saying that you are required to calculate the total equity of the parent company, which should be shown in the consolidated financial statements. So we never report the equity shares of the subsidiary company. We always report the equity shares of parent company only. So the equity shares of the parent company is 125, and by adding this figure with the retained earnings of the group, we got the value of total equity. So when the examiner says you to calculate the total equity, you have to add the equity shares of the parent and the group's retained earnings. So in the group's retained earnings, we have to take the full retained earnings of the parent company, which is 300. But for the ends for the subsidiary company, you have to take the post-acquisition profit. So initially we have got 90,000 retained earnings at the date of acquisition, and now it is 1,50,000. So there's an incremental post-acquisition profit of 60,000, for which we have to take 75% shares. So 60,000 into 75% share, it will become 45. And when we add this 45 into 325, we got the value of 470. So this is how we have calculated the amount of 470. Things clear? Now here is a challenge question for you guys. All of you are required to solve it and give your answers. Pratt acquired 80% shares of the equity share of Sam. Pratt well is known to favor and the equity. Goodwill was fully impaired. Okay. Conducting the favor exercise of Sam and its property plant equipment with the remaining life 5 years. Pratt. This is the count. Yes, very good to see. The right answer is A. If you are giving the question answers right, it means that you have a very strong grip on this topic, because it's a fact that mostly the students will not be able to answer this question in the previous attempt. So that's the examiner's view. So congratulations for you guys who have attempted the question, and I think you are going to score more than 80% marks in the examination. Oh, the people want me to explain. Okay, let me explain. It says that we are charging impairment loss in the income statement of 20,000, and there is an excess, there is a fair valuation adjustment of 5,000, for which you have to book an excess depreciation adjustment, 5,000 divided by 5 years. So it's 21,000 actually, which you need to adjust. But because of the fact that this adjustment is related to subsidiary company, therefore its 80% share will go in the retained earnings, and its 20% share will go in the NCI. And the question specifically asks you to identify the amount of the adjustment that you should have to make in the retained earnings. In the retained earnings, you have to make an adjustment of 16,800. Okay. So okay, one more last question for you guys before starting the consolidated income statement. After acquired 75% stone or initial capital, the fair value of the net assets of the carrying amount, with the exception of a liability which had a carrying amount of 20,000 below its fair value. Is it A, B, C, or D? D, B. The right answer is C. The right answer is C. So do you want me to explain? Yes. It says that the fair value of the net assets of the stone at the day of acquisition is equal to except the liability. Do you remember this, that we are talking about the liability which had a carrying amount below the fair value. That means the carrying amount is lower and the fair value is higher. So when we adjust this figure, that it means that you have to increase the value of the liability. So when you increase the value of the liability, what will be the impact on the net assets? If we increase the liability, what will be the impact on the net assets? Whether it will go up or down. If we increase, if we increase the liability, the net assets will go down. Very good. So when the fair value of net assets decreases, it will increase the goodwill. Okay. So are people getting this point? So that is the reason the right answer is C. This is tricky, yes. But why the increase is not 75%? Do we apply percentage? Do we ever apply percentage in calculation of the goodwill? No, we take the 100% adjustments of the fair value for the calculation of the goodwill. Yes, there is a goodwill upward. It's not goodwill up. Yes, we have to increase the liability. If we increase the liability, the fair value of net assets will decrease. And when the fair value of net asset decreases, it will increase the goodwill. So this is again one of the challenging questions for the examiner, which he says that most of the students will not be able to answer it. Impairment we deduct. When the carrying amount is greater than fair value, there is goodwill impairment. No, 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 no. You're. It's not about the carrying amount. If you're talking about the IS 36, it is actually the carrying amount and the recoverable amount. It's not about the fair value. How do we get 15,000? The 15,000 is wrong. The fair value is 20,000 less than the carrying amount. $800. Where is the 800 in this question? Don't have any 800. Answer is D. What C? At depreciation of the plant, where is the plant? Where is the plan in this question? We don't have any plan in this question. We're just asking. I'm telling you the right answer for this question is D. Are you people are getting this point or not? Right answer is C. Right answer is C. Right answer is C. Even if you want, I can say as many times as you want. What was, I didn't say D, it's C. I think we should have to move forward. Okay, if the concept is still not clear, you can ask me on the WhatsApp group as well. I can explain it to you. So let's move on towards the consolidated statement of comprehensive income. Consolidated statement of comprehensive income is one of the favorite question of the examiner. There's a student who were discussing that if the carrying amount below the fair value, then the fair value increases, and if the fair value increases, the goodwill decreases. My son, you have didn't understand the question. It is saying about the liability. It's not saying about the assets. It's saying about the liabilities. So if you increase the fair value of the liability, the net asset will be decreases. And when there is a decrease in the net asset, it will increase the liability. It will increase the goodwill. In which topic we get these concepts clear regarding the increase or decrease in the liability impact on the goodwill. It is basically a simple thing which you have learned in the basic papers of accounting. That is F3 and different papers like FA1 and FA2. That net assets means assets minus liability. If assets increases, net assets increase. If the liability increases, net asset will be decrease. These are the basic fundamental concepts. So now please focus on the format of this income statement. The most important thing for the income statement is that whenever we are consolidating a subsidiary company, we have to take the controlling period. So we only have to take the result of the controlling period. If the controlling period is less than 12 months, then it should be proportionated. Suppose we have acquired a subsidiary in April, starting from January, we have acquired a subsidiary in April. So it means that we are controlling that subsidiary from April to December. So it will be 9 months. So we have to proportionate all the results of the subsidiary to 9 months. So holding company plus subsidiary company minus intercompany sales. This could be asked. This would be one of the questions that the examiner can ask you in the MCQs. Calculate the consolidated revenue. Then for the cost of goods sold, we have to take the holding companies cost of goods sold plus subsidiary companies minus intercompany sales plus unrealized profit plus excess depreciation minus reversal of depreciation. So these are the basic adjustments that could be made in the cost of goods sold. So examiner can ask you a question in which you are required to calculate the consolidated cost of goods sold. Then there will be gross profit, then operating expenses, holding plus subsidiary, plus impairment losses. It will be recognized as a expense. Other income, holding plus subsidiary minus intercompany. If you have received any intercompany income, then it should be deducted. Negative goodwill is our income, it should be added here. Share of the profit from the associate, debt of impairment loss should be added. Change in the contingent consideration, gain or loss on investment at fair value through P&L. Finance cost must include holding plus subsidiary minus intercompany plus unwinding of discount of deferred consideration. And you will get the value of profit before tax. And when we deduct the tax on it, it will become a profit for the year. And other comprehensive means gain on the revaluation and gain or loss on financial assets or equity instrument measured at the fair value through OCI. So this is the basic format. You only have to memorize this format once and attempt the consolidated P&L question. You will be 100% correct if you follow the format. So one more thing that I usually recommend to students, that in the last few days, 2 or 3 days before the examination, don't go towards the book or even go for the exam kit. Just focus on the formats. Like you should know what is the format of the goodwill. You should know the format of the retained earnings, consolidated P&L, consolidated balance sheet, how you can calculate the consolidated property, plant and equipment. You should know the format to follow, the consolidated revenue, consolidated cost of goods sold, and how we can prepare the cash flow statement using the indirect method, investing activity, financing activity, and then for the final accounts, you should know how to prepare the income statement, balance sheet, how to present OC, other comprehensive income, and source sheet, that is statement of changes in equities. So you have to focus more on the formats and the concepts rather than doing some exam kits and the book or reading registers in the last 1 or 2 days before the examination. So it is highly recommended to focus on the formats because formats will give you maximum marks in CRQ area. Okay. Is that clear to all of you guys? So we still have 4 to 5 minutes. Okay. The next thing is this profit distribution. You have to distribute the profit between the group and NCI, and this is the format that you will follow for the calculation of NCI. First, we take the profit of the subsidiary into NCI percentage, and any gains or losses of subsidiary will be proportionated to NCI as well. Excess depreciation must be adjusted, and if there is a reversal of depreciation, it should be added back. Unrealized profit will be considered here only when the subsidiary sold goods to the parent company, and finally impairment loss share should be allocated here. So this is how we calculate the NCI share, and the remaining amount will be the share of the owners of the parent. So whenever we do the income statement calculation, we have to break the profit into group and NCI share. What is CC? CC means contingent consideration, the changes in the consideration that we had discussed previously. So moving forward, We will attempt few questions from the consolidated income statement, and we'll move on towards the ratios. All of you are required to solve it. So the right answer should be C. Very good. Very good to see. Students are giving the right answers. So the right answer is C. The student want me to solve. Now see here the cost of sales of the parent company is 710, and the cost of sales of the subsidiary company is 480 multiplied by 3 divided by 12. Then we should have to deduct the intercompany sales. And if the question says that from the date of the acquisition, the parent company sell goods consistently 20,000 per month. So as it has been 3 months after the date of acquisition, we have to take 3 months sales, which is 60,000. And finally, annualized profit will be added here, which is 4. So this is how we have calculated 774. Very good. URP. So it says that 20,000 is the amount of the stock still in the warehouse at the year end, and the markup is 25%, means we have to divide it by 125 multiplied by 25. So we got the value of 4,000. Now do not need to adjust NCA portion here. We take the whole cost of sales here first, and then calculate the profit, and after calculation of the profit, then we will distribute the share of group and NCI. So from the sales to the profit for the year, you do not need to exclude the NCI share. Is it done? Yes, moving towards the next slide. There's a one more slide for you guys to calculate the cost of sales. In this question, I'm expecting you to give the right answer. Yes, the right answer is A for this question. The right answer is A. So do you people want me to solve it? That's so simple. First, you should see whether we have acquired the company for more than 1 years. The answer is yes. So don't need to proportionate sold company's cost of sales. So parent company's cost of sales is 60 plus sold company is 100 minus intercompany revenue is 32 plus excess depreciation is 10 plus analyzed profit is 6. So this is how we have calculated the figures. Is it correct? How 32? 32 is an intercompany sales. Excess depreciation will be, as there is an adjustment of 80 divided by 8, excess depreciation is 10. Excess depreciation is 10. And for the analyzed profit, 32,000 is the value of the sales, in which the profit element is 25% margin based on 0.25. 0.25, 8,000, and 3/4 is still held in the warehouse. So 8,000 multiplied by 3 into 4. 1/4 is sold and 3/4 is still held in the warehouse. So why we didn't take 20 as a depreciation? So always remember this, that we prepare the income statement for the 12 months. So we only take the adjustments of the current year rather than the 2 years. Excess depreciation should be added in the cost of goods sold because excess depreciation is an expense, cost of goods sold is also expense. So both of these to be added. So moving on towards the next part. Okay, just one more question for you guys. $6,000 is the value of unrealized profit. PURP. Please solve this one. This will be the last question before starting the topic, ratios. The right answer is D for this question. So let's explain. The profit is 1 lakh, 6 months profit. Goodwill write-off is 10,000 and additional depreciation is 15,000. So when you subtract these two figures, minus this one minus this one, we got the value of, and we take 20% share for NCI. The amount will be 15,000. Is it clear? You have to take the 6 months profit, then goodwill written off, and excess depreciation of 6 months. So when we deduct these two figures, we got the value of 75,000, and NCI share will be 20% of the 75,000. I hope it's clear. Yeah, it will be proportionate, we have proportionate the whole amount actually. Like you can calculate this figure by taking the proportionate figure for all the figures. Like you can apply 100,000 into 0.2, this value into 0.2, this value into 0.2. Is equals to, even you can calculate it by taking the 20% of all the values at the same time. So we will get the value of 15,000 directly. So you can subtract the gross figures and then take the 20% in the end, or you take the 20% of all the figures. Okay, let me tell you. They're saying that what about the gain of 300,000? 300,000 will be the gain at the rate of acquisition, which will not going to impact on the NCI. For the NCI, you have to use this format that was told you guys previously. This is the format for the calculation of NCI. You can see here that we have calculated the value of NCI on the based on this format on the bottom of this slide. I think it's clear now. So let's take a 5 minutes break and we will start. It's 10:09 approximately PM. So we're taking a short break of 5 minutes and we will start at 10:15. p.m. Taking a short break of 5 minutes. Just refresh yourself for the ratios, and after the break, we will start working on the ratios. Thank you so much. Okay, so welcome back again after the break. So we are going to start the session again with the topic ratios. There are students who are having problems in the ratio topic. So what are the specific problems that the examiner has highlighted about the ratios? The first problem is the limited knowledge of the ratio calculation. Mostly the students are not comfortable with the calculation, or they do a lot of time for the calculation in the ratios. So do remember this, that examiner is least interested in the ratio calculation. So he's more interested to know about the comments. So you are requested to have a sound grip, to take a sound grip on the ratios calculation formulas, and to solve the ratios question very quickly. So the calculation should part should hardly take 4 to 5 minutes, and then you have to invest the rest of the time on the interpretation. Appraisal not linked to the scenario. This is one of the problems that usually the people give the generalized comments, which is not according to the examiner, is not acceptable for the examiner. Right? It might be the gross profit has increased because of this, divided by this, and that. So you have to link with the scenario if the question has tell you something about the particular ratio. Yeah, ratio question is very much similar to the PM. Okay. Limited understanding what the accounting information represents. This is one of the problem for the students, that they are not even able to understand the impact of the acquisition of the asset or disposal of the asset. And lack of commercial awareness, they don't have knowledge about the service, the difference between the service industry and the trading business and the manufacturing concerns. They all have different concerns, different issues, and you should know the basic, at least that these things on the basic level. Inability to come to the conclusion, and the most important thing is poor English. So for me, English, I think, is not that much issue, but the most important thing is, as if you know how to write the answer in connection with the scenario. If you link with the scenario, then definitely you'll get very good marks. But first thing that you should remind in your mind that you don't have to panic in the examination. So I usually hear from the students that they are confused about the ratios, how to write the answer, what to do with the ratios, and no. We will do right now. We will do 2 questions, and if you attempt these 2 questions carefully and in the way that I'm telling you, then you will definitely uh, got a good command on the ratios topic. So you have to be very attentive while we are discussing the topic. So starting from some generalized topic comments, profitability. When we discuss about the profitability, you have to discuss about the 4 things. The first one is the ROC, asset turnover, gross profit, and trading profits. So for return on capital employed, we have to take the profit before interest and tax divided by shareholders' equity. So when we talk about the shareholder equity, it means share capital plus all reserves. And debt, when we talk about the debt, when we discuss about the debt, that means all interest-bearing debt, even if the portion of the debt has been classified in current liability. So usually people assume that debt means non-current liability, but the advanced thing is you have to take all interest-bearing debt only from which you have financed your business. Like if you can see a deferred tax liability in the non-current liability section, it will never be used for the calculation of return on capital employed. So we always use interest-bearing debts, and even if the portion of the debt has been classified as current liability, you have to add that portion as well. Like when we discuss about the leases, the portion of the lease liability has been classified into current and non-current liability. So you have to add both of the liabilities in order to calculate the debt. Similarly, the loan, the part of the loan, if the company is paying the loan in installments, then the part of the loan can be classified into current liability. So it should also be included. Yes, include equity means all type of share capital and reserves, which might include the revaluation reserve as well. Similarly, for the asset turnover, we take the revenue in the numerator and shareholder equity and debt in the denominator. So do remember this point today in this period. It's very easy. It's very easy to comment on the ratios question and deal with the ratio question because you have to draft your answer from the scenario. So you don't need to learn anything. You don't need to accept the formulas. You don't need to learn any comments, and you should not be confused yourself that why what should I have to write. All everything will be available in the scenario. So you have to pick the thing from the scenario. Okay. If you're confused about a particular ratio that how what to comment about that ratio, then you have to understand this thing that for every ratios calculation, we are actually judging the performance of the numerator in comparison with the denominator. Actually, denominator is the base and numerator is actually the thing for which we are measuring the performance. Like the first one is the return on capital employed. Return on capital employed means that what return we are generating from the capital that we have employed in the business. So in the denominator, we take the capital employed, which is the shareholders' equity and debt component. And in the numerator, we take the value of profit before interest and tax. So profit before interest and tax is actually the one for which we are measuring the performance. So we are measuring the performance of profitability, that how much profit you are earning. And that is the difference between the return on capital employed and asset turnover. So when we discuss about the asset turnover, we are actually measuring the performance of the revenue, that what revenue we are earning from the capital employed side that we have invested. So if the ratio is increases, because the ratio has got the direct relation with the numerator. Remember this point. All ratios have a direct relation with the numerator. So if the ratio is increasing, that means the numerator might be increased. All ratios has an inverse relation with the denominator. So if the ratio is increasing, so the one of the possibility will be the denominator is actually decreasing. That's why the ratio is increasing. So examiner wants you to explain him that what is the reason of the increase in the ratio. So if there is an increase in ROC, the one possible answer is that there is an increase in the profitability over the period, or there is a decrease in the capital employed over the period. Similarly, if the capital employed has increased over the period, then the ratio ROC might go down because they both have a inverse relation. Similarly, for the asset turnover, if there is a decrease in the asset turnover, that means there might be a decrease in the revenue or increase in the capital employed. So these are the important things that you should mention. Don't use the formula total asset minus current liability while calculating ROC or asset turnover. We will always have to include current liability, loan liability in capital employed. Yes. Why? I mean what? Total asset less current liability. I don't have the time to explain why we should not use total asset minus current liability. I will explain you in the detail. If you want me, you can contact me on the WhatsApp. But from the exam point of view, you have to use the formula for the total equity plus non-current liability that includes interest-bearing debt only for the calculation of capital employed. Okay. So if there is an improvement in the return on capital employed, then it generally means that the company is generating good profit margins. And if there is an increase in the asset turnover, it means the company is earning a good revenue from the assets that have employed or the capital employed. Gross profit percentage, gross profit upon revenue or operating profit upon revenue. Gross profit is usually connected with the sales price and the cost of sales. And the net profit, operating profit, is partially connected with the gross profit. And the second part is linked to the operating expenses. So examiner, in all the cases, examiner will give you some hints. Actually, the hints that will make the 2 years ratios incomparable. So if you highlight that hint, that this hint is available in the question, the examiner will be more than happy. So in order to make the examiners happy, you still have to understand and read the scenario very carefully. Suppose in the previous year, we have the gross profit percentage of 20%. And in the current year, the gross profit percentage has increased to 25%. So the normal comments on the gross profit will be, sorry, I'm talking about the operating profit. Previously, we have earned an operating profit of 20% and now it is 25%. So the normal comments will be based on the expenses. But if you see a one-off income in the current year, then you have to highlight that one-off income, that this year's profit has increased because of the one-off income. Okay, there might be some one-off expenses which deteriorates the current year's profit. So you have to highlight that as well. So if you have got one-off profits or one-off income, like we got a one-off profit because when the company has sold a non-current asset and there's a huge gain on the disposal of non-current asset, which the company has recognized in the income statement. So current year's profit will boost up. And when we calculate the percentage, the gross operating profit percentage will be higher than the previous year. So you cannot comment on this like we have performed well in the as compared to the previous year. It is because of the one-off income. Similarly, you can see here that all over the world we all are facing a pandemic. So because of the COVID, there are lots of businesses who are suffering. So the lots of businesses are suffering. That means that there will be a lot of business who are not earning as compared to the previous years. So their revenues has declined, their profitability has declined over the period because of the COVID. So if you comment in the examination question that as compared to the previous year, the company is not performing well, so your comment will be wrong. Because if the question says that there is a COVID impact in the current year, so you have to give all the burden on the COVID. So you have to analyze this in the way that the profitability goes down because of this COVID particular impact that was mentioned in the scenario. So you have to link to the scenario. One-off income means the income which we have earned in the current year, but which will not be repeated in the future. Like one-off, there might be one-off investment income, there might be one-off profit on the disposal. So if you have earned a profit on the disposal on the non-current asset, so it will not be repeated in the future. then what you have to need to do is to analyze the performance by removing the one-off income or one-off expense impact, and then recalculate the ratio, and then comment on that on then coming on comment on it that after stripping off the one-off income or one-off expense, now what is the now performance of the company. Similarly, if the company has acquired another company, so when you compare yourself with the previous year, previously you were alone, and in the current year you have two companies. So when you consolidate two companies' results, the performance will definitely, you will see the improvement in the performance. But that does not mean improvement actually. It was because of the you have acquired a new company. So when you compared two companies' revenue with one company revenue, you will always see the improvement. So you have to strip off the performance of the new company, and then you can compare like with like. So we always compare like with like when there is a limited when there is a change in the as compared to the previous year, then your ratios will become incomparable. So I have given you the handout to read, and I'm directly jumping towards the scenario first. We'll do a scenario first, and then we will come back on this presentation slides. So I have two questions for you guys. Okay, the first one is the Moyer company. Now here you can see the Moyer is an international airline. We have to work on it. Right now we are working on it. The requirement is just 6 marks. You can see here the 6 marks is allocated only on the calculations, and remaining 14 marks will be for the comment and the interpretation. So if you calculate uh, all the ratios in a time of 20 minutes or 30 minutes, so you will lose the marks because you will only score 6 marks if you just calculate the ratio. So usually students do the calculation and spend most of the time on it and left the commenting area in the examination. So you don't need, you have to manage the time and solve the ratios in just few minutes. So 6.6 marks into 1.5 means you have to solve uh, in a 10 to 12 minutes at maximum. So you have 10 to 12 minutes in the examination to solve, to calculate these ratios. Okay, let's start, and you have to identify the differences. Moyer is an international airline which flies destination all over the world. Moyer company experienced strong initial growth, but in recent periods, the company has been criticized for underinvesting in non-current assets. That means this is one of the hint in the question that the company has been criticized by different shareholders or different stakeholders that the company is not investing too much in the non-current asset. So if it is an airline industry, that means that the basic commercial substance that you should know, commercial awareness that you should know about the industry is airline is a heavy investment industry. Like when you purchase the aircraft, you can buy the millions and billions of dollars will be invested to purchase even a single aircraft. And simultaneously it is a service industry, so there will be no cost of goods sold, something like that. So the gross profit figure will be irrelevant in this. So usually students ask me the question if the question does not tell us which ratio to calculate. So I normally suggest these 6 to 7 ratios to calculate, if the question does not specify what ratios to calculate. Okay. Sector average non-current assets 2006 and 2007. This is the interpretation of single company. Property, plant and equipment 174 to 317. Company has invested heavily in the property, plant and equipment, but it was criticized that you are not investing. Intangible asset value has increased from 16,000 to 20,000. Inventory has increased 490 to 580. Receivables is slightly decreased. Cash is substantially decreased. So if there is a substantial decrease in cash flow, that means the company is moving towards the liquidity issues. The share capital remains the same. Now the retained earnings remain the same, or more or less there is a slight increase in retained earnings. Now the revaluation surplus. Now this is the most important thing that you should understand. Previously we have no revaluation. Now we have got the revaluation of a substantial amount. So now you can link this with the property, plant and equipment, that the property plant, the value of the property, plant and equipment was not increased because of the investment in non-current assets. It was actually increased because of the revaluation. Okay, number one. The second thing is, so when we have no revaluation in the last year and we have got the revaluation in the current year, that means the previously, when we compare with the previous year, the equity will increase with a substantial amount. So the two ratios that we have discussed, in which in the denominator we have the capital employed. The one is return on capital employed, in which we have got the equity in the denominator, and the second one is the asset turnover. In these both cases, the equity will shoot upward. So if it will go upward in the upward direction, then the overall ratio will go down. So when you calculate the ratios, you will see that in comparison to 2006 and 7, the asset turnover and the return on capital employed must be in the downward trend. And we have identified the problem, and the problem is previously we have no revaluation, but now we have 1,45,000 revaluation in the denominator, which increase the denominator means that it will impact negatively on the ratio. So the both the ratios are understated and in fact incomparable in comparison to the previous year. Now the loan company has paid part of the loan, and here you can see this is the point which I was talking about, that the part of the loan has been classified into current liability. So when you calculate the return on capital employed, you have to add these loans into the capital employed as well. Trade receivable was increased substantially from 4,250 to 10,480. And then from the revenue side, the revenue has declined slightly, but there is a huge reduction in the profitability, profit from operations. Finance cost has reduced a little bit, and cash flow from operations is also decreasing. Information is also relevant. Moyer had exactly the same flight schedule. Now, this is the most important point that you should have to consider, that when you have a same flight schedule, how can your revenue will go down? So if the company has got the same flight schedule, what will be the reason of decreasing the revenue of the airline? So the possible reasons could be the low prices, very good. And offers also the low number of passengers, less number of passengers, very good. This is called commercial awareness. This is what the examiner wants from you guys. So if the revenue is decreasing, and the number of flights remains the same, then it means there might be low prices that we are charging towards the customers, or there might be less number of customers who are traveling. Like in the COVID period, you can see there's a SOPs that you should have to follow, and there's a distance, minimum distance that you should have to maintain. If the aircraft has got a capacity of 500 passengers, they will not be allowed to pick more than 250 passengers. So you have to put the passengers uh, after a gap of one seat. So previously we have uh, placed in the passenger in the aircraft seat by seat, but now if you're traveling, then you have to make a distance of one seat. So the capacity of the aircraft has reduced. So this could be one of the reasons. So these are the hints. So we have up till now we have identified few hints. The first hint is there is a revaluation which increases the overall equity and then definitely will reduce the asset turnover and ROC. Secondly, there is a substantial reduction in the cash of the company. Company is not investing on non-current asset. This is the third point. Then company has paid part of its loan. Fourth point, there is a substantial increase in the trade payables of the company. The revenue has go down, but the key point is the flight schedule remains the same. So you have to identify what is the reason behind this. So we have identified there might be a low airfares charged to the customers, or there might be a low number of customers who are traveling. Profit from the operations has go down, so we have to identify the reason for this. Finance cost is slightly go down because we have paid the loan interest, and the cash flow from operations has also decreases. So these are the points that you should remember, and these are the actually points you have to incorporate when you are writing your answer. That's it. Now, in April 2007, our year end is 30th June. So just April, May, June, just 3 months before the year end. Just 3 months. So when we have been given a date, you have to identify and link it with the year end. So just 3 months before the year end, Moed had to negotiate its license with the 5 major airports, which led to an increase in the price Moed company had to pay for the rights to operate the flights. It means that the company has invested a big amount of the capital into the license. So if the company has invested a huge amount in the license, that's why the reason the cost has increased from 16,000 to 20,000. So company has invested the amount in the license, and we all know that whenever we have got the license, we have to charge the debt amortization of that license. So one possible impact of reducing this profitability will be the amortization of the license. Just mark this point. One of the possible reason for the reduction in the profitability is because of the amortization of the license. But you must know this thing that we have to charge the proportionate amortization of the license, which is approximately for the 3 months. But when we charge the full year's amortization, the impact will be even more worse. Secondly, someone can say that the company has increased its operating expenses because of this particular issue. But when you have seen in the question that's mentioned that we have the same flight schedule, that means mostly the operating cost remains the same. So what is actually impacting on the profitability of the business is one reason might be the low airfares or less number of passengers who are traveling. The second thing is the amortization of the license. The license with the 10 more major reports are due to expire in 2007. The Moyer is currently in negotiation with these airports. So the license with 10 or more airports are due to expire in 2007. So currently, whatever be the impact of the next of these 10 airports will be impact on the future. Right now, we don't have the impact of these renegotiation in the current year because still till 31st December we have got the license. But the question specifically says here that comment on the performance and the position of Moyer for the year ended 30th June 2007. Your answer should highlight an issue which Moyer should considering in the near future. So when we talk about the near future, then you have to highlight this issue that we are in a negotiation of 10 more airports, and in the future the cost will be increased, and if the company will not be able to maintain to pay the license fee, then it might lose its revenue and profits because you will not be allowed to uh, to land on that airports on these airports. So these are the future impact that we should have to discuss. One more thing which is relevant here is you can see here the cash generated from operation is decreasing over the period. One more thing that you should know is that the company is paying the loan installment which is equivalent to 19,440. So 19,440 is the amount that the company should have to maintain in order to pay off the liability. The second most important thing is the company has to pay an interest of 9,200 minimum. So on overall basis, your liability is 19,440 plus 9,200. So it is approximately equivalent to 27 to 28,000 roughly. The figure that you should have to pay for the loans. But from the operations, you are only earning 18,000. So you are in negative deficit. That's why you can see here that the cash flows of the company are decreasing over the time period. What's the question? Yes, you can see here that the cash flow of the company is reducing because you have to pay annual installment of 19,440, and at the same time you have to pay the interest costs. And when you compare the debt and the equity, in the last year we have got the equity of 44,000 only, and the debt is 1,50,000. It says that the loan provider has invested more in the Moyer as compared to the shareholders. So the shareholders' investment is lesser, the equity is lesser, and the Moyer is mostly financed by the loan providers. So this is also one of the concern that the company is actually in the control of the loan provider because they have invested the more amount in it. Yes, the company is in debt trap. So I'm giving you just 2 minutes, take few minutes and calculate the ratios of this company for the 2 years. I'm giving you a few minutes. All of you are required to calculate the following ratios of the 2 years. The first one is the operating profit margin, return on capital employed, net asset turnover, current ratio, interest cover, and gearing. I was just saying that the company is largely financed by the loan instead of the equity. So company should have to do something in order to improve the equity and reduce its loan. Because when we have increase a loan, there will always be increase in the finance cost. And when there is an increase in the finance cost, we will be having lesser profits for the shareholders. Yes, we can issue shares. Yeah, that's a good suggestion that the company can issue more shares and pay off its liabilities and save the finance cost for the shareholders. Equity has increased significantly because of the revaluation. We do not have injected capital into the business, so we cannot pay off the liability from the revaluation surplus. You can see in the balance sheet, the equity is only increased because of the revaluation. So I'm giving you just 2 minutes to calculate the ratios. Then we will start working on the comments. You can just search September December past paper, or you can just write Moyer and on the Google HCCFR Moyer, you will find the question paper there. Because I have to move the screen every time upward or downward to show you the data. So it's better for you to just open. Even this question is available in the most recent exam kit as well. Here is the financial data. So now starting. So first you have to match your answers with the data that has been provided to you. So if you wanted to ask anything related to this calculations, you can ask it immediately. Please do ask if you have solved it already and you have some confusions. If the calculation is right, then we can work on the how many decimals should we use to calculate it. 1 or 2 decimal places is enough. 2 decimal places, not more than 2 decimal. After the session. These are the questions I am picking from the past papers. Actually, you can see this is the past papers of ACCA FR paper. These are the past papers. I am selecting the papers from here. So right now we are working on September, December past paper. So Moyer is the part of this past paper and we are working on this solution. Okay. So let's analyze the calculations. Operating profit margin has declined. Operating profit margin has declined over the period. So what will be the reason for this? Operating profit margin has declined over the period. So one of the reason could be the company is charging low airfares. That's why the profitability has gone down. The second thing is the company might, yes, the company must have charged the amortization of the intangible assets for the 3 months amortization. So that will be the one of the reason for reducing the yes operating cost has increased because of the amortization. Yes, you can also comment on it if the revaluation was done before the year end. There could be excess depreciation that the company has charged, but usually the company has done the revaluation at the end at the year end. So its impact of the excess depreciation will come in the next year actually. So you can write it, but you have to give your answer in a way that if the company has done the revaluation before the year end, because it's not mentioned here that when the company has done the revaluation. So there will be there will also be impact of the higher depreciation. But as I said that usually companies charge depreciation, companies do the revaluation at the year end. So that's why its impact will come in next year. So these are the points that was given in the question. So all you need to do is to analyze the scenario and you have to respond according to the scenario. So don't need to work on the number of range of comments. Just focus on the scenario and link your answer with the scenario and then move towards the next ratio. Secondly, you see a substantial decline in the ROC, return on capital employed. So it was because of the revaluation. The company's return on capital employed has go down. So can you recalculate the return on capital employed ignoring this 1,45,000 revaluation? So what will be the ROC if we remove the effect of the revaluation? Company charged lower profits in order to reduce the selling price. Yes, company has reduced the airfares And that is the reason the profitability has go down over the on overall basis. Now, can you recalculate the figures? Removing the effect of revaluation of 1,45,000. The ROC has go down from 8.7 to 3.6. So one of the impact was due to the revaluation. The second was because of the because of the profitability. You can see here in the numerator previously we have 18,600, now it's 12,300. So the second impact was due to the profitability. Yes, it's 6.2%. So even if we remove the effect of the revaluation, it is 6.2%. So why it's still decreasing? Because there is a decrease in the profitability over the period. And why the profitability has decreased, we have discussed it already here. So you don't need to repeat the things again and again. So because of the fact that the company is charging low airfares, one of the possibility is for the reduction in the revenue profitability. And the second is that the company has charged the amortization, 3 months amortization for the current year. That is one of the reason of lowering the profits. And if the company compares the ROC with the previous year, there is a substantial or drastic decline in the ROC, and it was due to the revaluation. The first thing that you should have to highlight, which make the 2 years incomparable. And even if we remove the impact, the percentage is approximately 6.2 or 6.5 something. Then you can say here is it was all because of the declining profitability. And you must know this, that the return on capital employed is a multiple of asset turnover and net profit ratio. So one of the reason for the decline is because of asset turnover. Asset turnover, you can see here there's a huge decline in the asset turnover as well. So the next point is asset turnover. There is a decline in the asset turnover the period. So the one of the reason for the decline is again the revaluation impact, which is shown in 1,92,000. So if you remove the effect of the revaluation, then what will be the asset turnover? Yes, declining the asset turnover is also because of the revaluation. So can you recalculate the effect of amount of the asset turnover, removing the effect of revaluation? 0.78 times. Wonderful. So that means previously we have got 0.74 and now we have got 0.78. Just try to understand this point. Previously we have got 0.74, now it's 0.78 if you have to remove the effect of the revaluation. The question is why it is increases, because you can see here that revaluation, the revenue of the company has go down. The revenue of the business has decreases from by 5,000 rupees. So why this asset turnover has increased? Why it is slightly increased? Because the revenue is going down. Because improvement in the asset turnover means the company is generating better revenues. So again, it is because of the impact of the loan. You can see here that there is a loan of, previously we have got a loan of 1,50,400, and now we have paid part of the loan, and now it's 1,30,360. So whenever there is a decrease in the denominator, the ratio will go up. So first you have to comment on it like this. The previous year, the company is generating an asset turnover of 0.4 times. Now it's 0.45 times. The reason was because of the revaluation, okay, which makes it incomparable. Then you have to write, if we remove the impact of the revaluation, the new or the revised asset turnover will be 0.78, which shows an increase in the asset turnover. But as the revenue is going down, then why it is increases? So it is increases because of the repayment of the loan. So because the company has paid part of the loan, so that is the reason the company's asset turnover has shown increase. Is that clear to all of you? Okay. But the first line that you should start with, always start with the revenue. So first you have to write the revenue of the business has declined over the period from 159,000 to 154,000 over the year. And as the scenario says that the flight schedule remains the same. So why it's decreasing? So the reason could be less number of passengers is traveling, or it could be due to the low airfares that we are charging to the customers. Okay. So these are the points that you should have to discuss in the profitability. So first three ratios will be for the profitability. Then next two ratios will be for the position, that where the company is standing right now in terms of current ratio, interest cover, and gearing. And you have to add one more thing, which is its future impact, because the question is specifically mentioned in the requirement. You are required to, your answer should highlight any issues which the MOIA should be considered in the future. So I'm giving you just 1 minute to read the answer of the examiner. Do remember this point, examiner never expect the same level of answer that he produces. So your answer might be 60 to 70% of the examiner, which will be totally fine with the exam point of view. We didn't discuss about the future impact right now. We have just discussed about the profitability. And so I want all of you to just read the profitability first, then we'll move on. So yes, have you people read this answer? I have shared the uh, time management in the group today as well. So you can see on average, you can say that we have got 1.5 to 1.8 minutes per mark. So if you are attempting a 20 marks question, you have to solve this in 20 multiplied by 1.8. It will be around 30 to 36 minutes. So you should spend 30 to 36 minutes on average. 36 is the higher limit. Try to cover up the question in 30 to 35 minutes and do the practice. So, do you people find this question difficult after reading the first phase? Is it difficult to attempt this question? I don't think so. What's your feedback? So, all you need to do is to solve 3 to 4 questions based on. No, don't write bullets. Write write in the paragraph, short paragraph like this. So, if we go through the 3 to 4 questions like this, then I must say that this topic will be peanut for you. Even do remember this: if you calculate the wrong ratios and you're doing the right analysis, you will get the marks of the analysis, and deduction will be made only from the ratio side. Understanding of the ratio is not that difficult. You have to but just understand. We will try to solve one more question today so that you will get benefit of it. Okay, the second phase is the position analysis. When we talk about the current ratio, you can see here that the current ratio of the business goes down from 1.22 to 0.53. So who is the ultimate responsible party for this? So you can see here that there is a substantial decline in the cash flow over the period. So one of the reason for this is the substantial decline in the cash over the period. And the second thing is substantial increase in the trade payables. So these are the two parties who is responsible for the decline in the current ratio. Okay. And it shows that the company is facing liquidity problem. So what are the reasons behind this, that why company is facing a liquidity problem? Because the company is in the process of negotiating, uh, the company has negotiated 5 licenses, and they paid a huge amount of cash in order to buy the licenses. So that is the reason the company is facing this problem. And the second one is the company's liability has increased over the period more than the double trade payables. Okay. And one more thing is the company has to pay a huge amount of the interest and the installment of the loan. So these are the reasons which are impacted on the cash flows of the business and overall current ratio. Now the interest cover, the interest cover is decreasing partly because of the profit is declined over the period, And you can see here there is a decline in the profit from 18,600 to 12,300. Even the company has paid some of the loan and there is a decline in the interest expense over the period, but still the interest cover is 1.3 times, which shows that the most of the profit is used to distribute the interest, and very lesser profit is available for the shareholders. Now the gearing, you can see here, previously we have got 379.1% gearing, means the loan component is three times higher, more than, in fact, three times higher than the equity. But now it's 38.3%, 78.3%, which was due to the repayment of the loan, and there is a gap, substantial gap in the debt equity. Company might think of to issue new shares in order to raise more capital, because company has issued very few shares right now. The company can issue more shares in order to inject more capital and repay the loan and save the finance cost as maximum that the company can. So these are the things that you should have to write in the position. Now, what about the future impacts? Now, the future impacts of the companies, the first thing that you should know is the company is not investing on non-current assets. So in the future, the company might have to invest in the aircraft or some other parts of the aircraft, for which the company has to manage the cash, which is, you know it from the scenario that the company is having a cash flow problems. Secondly, the 10 airports which the company is in the process of negotiating in the next year, that the company will be in the process of negotiating in the next year. If the company will not be able to renegotiate that, it will give the great loss to the company in terms of the revenue and the profitability. But even if the company wins the licenses in the increased prices, they have to pay the increased prices, for which again there will be the burden of the amortization in the future periods, for which the company has to consider. Then the future thinking that the company should think of is they have to pay installment of 19,440 on an annual basis, plus an finance cost of 9,200, for which the company should have to manage minimum this amount of the cash flow in the future. So these are the basic concerns which is related to the future. So I want all of you to just read this one, then we will move on towards the next scenario. Now, this is the position analysis of the company. Please read it. Please read it carefully. If you have already read it, please give me the go ahead so that we can move forward. Have you read it? Okay, that's great. Now we are going to solve another question. Here we have a question for you with the name Perlo Group. This was asked in March June 19 attempt. It's a question in which you have to calculate the gain on the disposal on the Perlo Group, and then you have to calculate ratios. So you can see here that the examiner is only expecting you to calculate the three ratios: the gross profit margin, the operating profit margin, and the interest cover. So you are only required to comment on these three ratios. So this is called the consolidation analysis question, in which examiner will give you a question from the group. This is parallel group, and you are required to solve the question. So the question is the overall performance of the parallel group, how once accounted for disposal of the Simba will impact on analysis, and the implication of the disposal of the Simba. So first of all, I want you people to just read the scenario with me. Consolidated profit and loss of the Pillar Group for the year ended 30th December 2008 and 9. We have been given some ratios in which you can see the decline in the revenue, decline in the cost of sales, little bit, and decline in the GP. So the change in the revenue is comparatively lesser than the change in the cost of sales. So therefore, you can see a improvement in the gross profit. Operating expenses, operating profit margin, finance cost, investment income. Then you can see here there is a share of associate profit that have booked. Tax expense, lowering the profits as compared to the previous year, and distribution between the owners and NCR. Now, at 31st December 2009, what is the date? It's at the year end. The Pirlo Group disposed of the entire 80% of holding in Simba. So we have a subsidiary with the name Samba, sorry, and we have sold 80% of the shares of whole of the 80% shares of the Samba, a software development company for 300. Samba was actually the software development company. The Samba results have been fully consolidated into the consolidated financial statements above. Samba does not represent a discontinued operation. So, if the Samba was disposed of during the year or at the start of the year, then you can say that these 2 years are not comparable. But it clearly says that the Samba results are completely included in this data. So these two are still comparable. Now, the proceeds from the disposal have been credited to the suspense account and no gains or losses have been recorded in the financial statement. So still there has been no gains or losses which has been recorded in the financial statements. The third point is the Pillu originally acquired a shares in Samba for 210. At this date, the goodwill was calculated at 70 and the goodwill has not been impaired. The external advisor estimated that okay, first we need to calculate the gain or loss in the books of the parent company. So parent company, which is the Pillu Group, has acquired the shares in 80% shares in the Samba company for 210 and they has disposed of for 300. So the difference between these two will be the gain on disposal in the books of parent company. Gain on disposal in the books of parent company. So we have acquired the investment for 210 and sold it for 300. It means there will be a gain on disposal of 90. So the first requirement is to calculate the individual financial statements Pillu and the gain on loss and disposal. So the answer for this part will be 90. So out of 5 marks, you will get 2 to 3 marks after just seeing the notes. So it's mentioned here that we have acquired the shares for 210 and sold it for 300. There will be a gain on disposal of 90. Okay. The goodwill has not been impaired since acquisition. The external advisor estimated the goodwill as arising in the value of 110. This is a very important point. Initially, we have calculated the goodwill of 70 and now it's 110. So do remember this point. According to IFRS 3 and ICCA, the impairment of goodwill is allowed, but you cannot revalue the goodwill upward. So you cannot revalue the goodwill upward based on the market value. So this question says that the external advisors estimate the goodwill arising on the Samba is valued now 110. So you cannot take this 110 figure. So only we take the goodwill at acquisition always. We can have impairment in this value, but we cannot never increase this value to upward. Then it says that on 31st December, Samba had a net asset. Now these two notes, note number 2 and 3, was given to us at note number 5. In fact, 3, 4, 5. These 3 notes are given to us in order for which you are required to calculate the gain on loss and disposal in the group's financial statement. We will calculate it just after 3 to 4 minutes. First, we read the scenario. On the reverse December, the Samba's net assets were carrying amount is 260, and this was for the calculation of gain or loss. Samba is only a subsidiary in which the Pillu owned less than 100% of the entity. The Pillu group uses the fair value method. Okay. First, you have to identify from this statement that the Pillu has got more than one subsidiaries, and Samba is the one of the subsidiary in which it has 80% shares, and all other subsidiaries are 100% owned subsidiaries. And it says that the value of the non-controlling interest is 66. Now, until December 2008, the Pillu rented space. Now, this is the important point. And its property to the third party. So previously, Pillu Group rented its space to the third party for which Pillu received the rent. This agreement ended on 1st January. Samba Administrative Department moved into the Pillu company's property. Okay. So what will be the impact of this? Pillu charged Samba companies reduced rent. So there will be two impact for this transaction. First, on the individual basis, there will be a saving of Samba company's rent. So Samba company, if they hired a new property or they move towards a third party's property, they have to pay a huge amount of the rent. But they are shifted in the parent company's profit, so uh, they are paying the reduced rent. So if they are paying the reduced rent, that means that it will impact positively on their profitability. Okay. The second thing is the Pillu company's rent, which they are charging normally, will receive a reduced rent from the Samba. So it will affect negatively on the profitability of the Pillu group as well. Pillu charged Samba, okay, Samba company's property sold in 2009 at a profit of 2 million, which is included in the administrative expense. Now, this is again a point that you should have to understand that the Samba company has sold its properties at a profit of 2 million, which is a one-off profit which is being recognized in the Samba company's income statement. So definitely the profitability of Samba company will go up in the current year. So you can see here in the operating profit margin section that previously Samba company has earned a profit of 41%, which is now 66%. So when you are commenting on these two parts, this part, you have to identify this that the one of the impact of this increase was due to the Samba company is paying the lesser rent to the Perlu group, number one. And the second thing is the Samba company has sold its properties and there is a gain on the disposal of 2 million which has been included in the P&L. So there is a one-off impact on the Samba company's profit because of the gain on disposal. Then it says on 31st December 2009, employment of the two founding directors of the Samba was transferred to the Perlu company. So the two major directors, founding directors of the Samba, because we have sold the Samba company, but we have retained these two directors. So the company has retained these two directors and sold the Samba company. From the date of the disposal, Pillu will go into the direct competition with the Samba company. As a part of this move, the directors did not take their annual bonuses of 1 million each from the Samba company. So one of the reason of the increment uh, in the profitability of the Samba company was due to uh, there is a saving of bonuses of the Samba company. Instead, they receive a similar joining fee from the Pillow group. So Pillow company is paying the joining fee to the directors instead of the Samba company, which was paid to them on 31st December 2009. These individuals have excellent relationship with the largest customers of the Samba company and are central to the Pillow company's future plans. So Samba company, Perlu Group has sold the Samba company and retained its two founding directors, and which they will use for the future growth in the business. Samba company's revenue remains constant at 26 million in both 2008 and 2009, and Samba has a higher level of debt. The key ratios. Now, try to understand this point. If the Samba company's revenue has remained the same in both the years, how can the revenue of the business has go down? So if Samba company's revenue remains a constant over the period, so there will definitely be the decline in the revenues of other members of the group, which might be Perlo Group, Perlo Company, which is the parent company, or its subsidiaries. So you have to identify this point as well. Okay. Secondly, when you calculate the ratios, can you calculate the three ratios of based on this data? You can calculate it quickly. Gross profit, operating profit, and interest cover. You have a data here. Gross profit, operating profit, and interest cover of both the years. I'm giving you just 1 minute to calculate it. Be quick. Now, have you done this gross profit, net operating profit, and interest cover? I'm showing because of the time limitation. Showing here the answer as well. The answer for the first part will be 90,000. The answer for the second part will be 14,000. So here you have to see that the company, Samba company, was sold by the group at a loss of 14,000. Besides the fact that the Samba company is a profitable company. Check the profitability of the Samba. It's 80% and 81% gross profit, and 41% and 6% operating profit. So is it a good decision for the company to sell this profitable company? So this is a question mark. Okay. Now you see the gross profit. When you see the gross profit percentage, it has increased slightly from 44.9% to 45.8%. But when you see the result of the Samba company is generating a profit of 80% and 81%, which is included in this profit. So what does it mean? It means that the group as a whole is earning a profit of 44.9 and 45.8%, in which Samba company's contribution is 80 and 81%. It means that the rest of the members of the group is working at a very lower profit margins. The rest of the group members is working at a very low profit margins. Then you see a decline in the operating profit. These questions are so time taking. How can we manage? It's not time taking actually. As you are doing it for the first time, when you do 3 to 4 questions like this, you will get perfection after attempting 3 to 4 questions. But you have to practice like this in the manner I'm telling you. Second thing is the operating profit margin of the company has go down, decreases, whereas you can see the Saba company's profitability has increased over the period. So why Saba company's profit has increased over the period? Can you tell me why Saba company's profit has increased over the period? Because of what? Why Saba company's profit has increased over the period? Because of the two things. The first one is the saving of the rent. The second thing is the saving in the bonuses that they have to pay. And the third thing is they have sold the properties for which they have recognized a gain on the disposal. Okay. Okay. Now, what does it mean? Despite of the fact that the Sama company's profitability, operating profit is increasing over the period, the overall profit of the group is going down. What does it mean? What does it mean? If the Sama company's profit is increasing, which is included in this operating profit margins, and on overall basis the profitability is going down, what does it mean? It means that the other members of the group is at loss. The other members of the group might be in loss, because if there is an increase in the profitability of the Samba, then there should be increase in the profitability of the overall group. But you can see a decline in the profitability of the overall group, which shows that there might be other members of the group which are at losses. So there are loss making might be companies. Okay. Then one of the benefit which the Sama company is gaining was because of the saving in the bonuses, and there will be a cost of the Pillu company as they have to pay the joining fees, but they will get the benefit in the future for this joining fee. What about the interest cover? Interest is 1.8 to 1.3. Overall interest cover is decreasing. But when you see the result of the Samba company's interest is comparatively low. So from this perspective, it's good to sell the Samba company, because when you sold the Samba company, the overall interest cover of the company will improve, because the Samba company is highly geared company. But from this perspective, when you see that it is a profitable company and the company has sold it at a loss of 14,000, then this is not I think this is not a good decision from the group's perspective, because we never sold a profit making company at a loss. So these are the points that you need to discuss. So I'm giving you just this point of the examiner's answer. Just read it carefully. Please read the answer of the examiner. it okay to refer to answers to complete the section C question? I didn't get you. Can you repeat your question again? Please read the answer very carefully. Have you people read the answers? I'm asking general for attempting any kind of section C questions. If it will be good if you first attempt it and then you can go and see the answers. Have you people read the answer? Is it done? There's some. This is the conclusion. Please write yes if you have done. If you have read the whole answer. Okay, yes. Okay, that's the end of the session. So thank you so much for your timings. Thank you so much for giving us this time, and I really wanted to thank ACCA for providing me this opportunity and meet with you people. And I find a very good students and very energetic students who wanted to pass the exams in first attempt. I'm available till the exam date on the WhatsApp group. You can ask any type of questions from you. And I hope this session of 15 hours has increased your confidence on the subject. And I have tried my best, in fact, to improve your concepts and try my best to focus on the core areas of the paper. So I think definitely this activity provides you some benefit, and definitely it will reflect in your result. But it's my humble request to all of you to please follow the plans that I have shared on the group. I have a separate plan for the retakers and the different plan for the resitters, for the first timers. Please do follow the plan that I am suggesting, and do remember me in your prayers, and please give your valuable feedback on this prepare practice to pass session to the ACCA so that they will organize this type of same type of events in the future for the students. And my videos will be provided to you. It's available on the Vimeo. And if you wanted to study any topic, like one of the student is talking about the borrowing cost. So if you want a video of any part of the course, I can provide, I'll share you on the WhatsApp group. So thank you so much for your time. It's a wonderful session for me. And I hope you people have learned a lot from this session. And again, I wanted to thank ACCA. And it's really nice to see the people from different parts of the world. And yeah, borrowing cost is a part of the syllabus. So for the ratios interpretation, I would recommend all of you to just attempt these two questions again and try to write your answers in the constructive response workspace Word document and solve these two questions and then read the answers and attempt one more question from the single company and one question from the consolidated. You will find the ratios topic and interpretation very easy. Thank you so much for the time and do take very good care of yourself. And bye bye from my side. Take care. Love.